Hello guys, this is Alex. For a long time now, I wanted to make a proper tutorial on how to use the SDS system, which is the Strategy Diversification System. To not go too deep into it, the Strategy Diversification System is probably about 6, 7 strategies that I've picked out by hand, tested over time, and then put into an allocation basket based on their performance and risk. And then I also added a couple of behavior things like net limiters to reduce at certain points before the strategies actually reduce overall. Most of the time, if it's a big enough move, they're all going to reduce at the same time. And when it's going down, there's kind of like a reserve capital where if the system starts to really get drawn down, like 72% of the system is only mean reversion. And mean reversion is basically when you're buying dips on the way down, and trend is when it's buying on the way up. So it's 20% trend, 72% mean reversion. And if we're going into mean reversion trades, the chances of the trend being in is very minimal. So most of the time we have about 78-80% of our portfolio into a dip, and then we slowly allocate in from there. And that's the kind of idea to spread out the drawdown. But to go into the SDS system, I wanted to make a strong tutorial how to set it up from scratch, what it looks like, what all the features does, and how you can fiddle around with the settings to make it something more comfortable for you. Now, I'm not a financial advisor. I don't even have a college degree. I don't even have a certification in finance or economics. I'm just a guy that played around with stocks way too long. I survived in the game for about 7 years now, going strong into this investing, trading area. I failed many times, but still standing, and I found something that worked for me long term. Um, when you get the link for the strategy diversification system, it's going to take you to this page. Now, on the phone, it's going to be super congested. But at the top here, you're going to see that there's a star. You just press on the star. That's going to add it to your favorites. You may have to restart the program because most of the time it doesn't update directly onto the phone right away. But when you do, you go into your indicators, you go into your favorites tabs. These are all the different trading scripts that I've made over time, but it's going to be just SDS. So you can double press that or just press it once if you're on the phone. Oh, let's take that off. It takes a little bit to load because it's 1100 lines of coding. So it does take a little bit of time to get on. You're going to be met with this user agreement. This is really for my protection and for your protection. Understanding that there are financial risks when you're using a system like this. There's always going to be ups and downs. Going into this here, once you want to see, if you want to see the trading system itself, you have to sign up for the user agreement. So you go into this little eyeball, sorry, the eyeball is to the hide, this little hexagonal eyeball just to the right of it. You click on settings, and then you just have to, I have read and agreed to the terms of use. That'll automatically kick on the system and its allocations. And at first, the amount of shares that's being held going to be a little chaotic because we're running from $1,000 going all the way back to 2009. With TQQQ, that's the data that we have. But you'll be able to go as far back as you want to see all the allocations, what it did at certain times, how it performed long term. So setting up everything, now that you have it on the page, you have your little allocation up to the top here. We can make that bigger. So we can start from the top here before I start working my way down. We have a use date range filter. Now, primarily for me or for you is that if you want to have accurate share amounts and you want to know exactly what you're going to be purchasing at the end of the day, you have to use the use date range filter. It is going to take away data from the historical tables that you use. So I recommend always having one script up so that way you can see what the history was, do your research on each stock that you plan to use this on, and one that's going to be your personal usage of your end of day trading. So with this, you can always, like, it's pretty straightforward and explanatory. You could change it from any year. So like if I go all the way to 2025 and let's say I wanted to start the year off strong, I always kind of go back 2 days. So let's say if I wanted to record what happens on to January, it's going to take away pretty much the allocations that I had any time before this. So if a mean reversion trade was on the 17th and didn't close until the 31st, you don't get that benefit going into the next year. So I always kind of like back it off a bit by a couple weeks. And then you can see the share count immediately go down. And this, in the properties here, you can adjust this. So let's say this year I wanted to start off with $50,000 on it. Now you can have a share amount that's proper to your capital, and that was in properties right there. Style, we can really just take off the quantity. If you don't care about the share amount and you don't want to see it, you could take away the cluster, you can take away the tables, but really quantity is like the only thing that I take off. Now going into it, now that's the use date range filter. I always extend it out by a couple of years just to kind of give it some leeway, because I don't really want to update the script all the time. You have a capital usage multiplier, which I will get back to because I want to show you with all the tables how that affects your trading and risk. And then we have the allocation table. Right now, naturally, it's on tiny. If you're using your phone, you want it on tiny. You don't want it to take up the entire screen, but you can put it on normal and it will blow it up as such. Then you have your yearly performance tables. You can just click on that. That'll generate onto the bottom. Let me reset this so that way I can show you guys the history. We'll start with 2027 or 2007. There we go. Cool. Let me go back to properties, sorry. Just going to adjust that. Okay. With the yearly performance, it's all year to date, recording from the start of the year to the finish of the year. I don't want you to be deceived by the numbers when you're looking at the year to date, because a lot can happen in between the year. Like especially this year, we're not really making any money. We stayed light relatively most of the time. We've been chopping later into the end of the year. We were drawdown over here. So we haven't really gotten a huge amount of benefit in this current market. But it's kind of a good idea, like, hey, this is what the average yearly return is at the end of the year. So you know that if you look a year out and it's April and you're down 20% on this system, you know that there's a good chance towards the end of the year that you're going to be positive, or you could be slightly less negative. But you can kind of go back into the years and you can kind of use this as a gauge for your future trading, or when you see that the system is in a rut, that can affect your decision making as well to kind of participate. With the yearly table size, there is normal and small. So you can make it really tiny, and that's prefer for the phone. There is a monthly returns table. Now it typically just starts off at tiny for your phone again, and usually at 5 because it's relatively big on the computer, on the phone. You can do all the way up to, let's say, like 17. you can see the monthly returns going all the way back to 2010. So you can see like this year in 2026, January through December, 5.17%. Then we did 3.3 in February, negative 3.3, negative 7.7. So we were going back close to like negative 8%. Then we had a 5.9, 1.8, 7.6. We had a really good month, and then another shave here in July as of recent. But you can go back to like 2022. You can see that January was negative 14.9, and then the next 2 months you gain what? That's 25%, 26%, and then negative 15, and then another 13. Like, these are numbers to take into consideration. Like, are you willing to take this type of volatility with a system? But you can see like 76% in March of 2020, which is absurd. But you have that data there that you can go on. And I'm going to just make that really small. You can have it really small for your phone. You cannot, one thing to mention is you cannot have the monthly returns table and the yearly drawdown table all at the same time. It's going to block each other out because they're both stuck on the left corner. Then we have equity curve. Equity curve is great. Usually it starts with 5. I prefer to cut this down to 1. And when I use my equity curve, I'm going to go over here to style, and I'm just going to lower the thickness down. I prefer to have it like as a green. And we go ahead and find it. Now we're $1,000 back in 2010. So what would that be today? I imagine it's going to be quite a bit amount. There we go. So now you can go back and you can cut all the way back to 2010, seeing its equity curve, seeing how it's taken its hits over time. Notably, what I really like about the system is back in 2022, when shit is really hitting the fan, we didn't really follow that index. That's my favorite part. In fact, we actually had a positive year in 2022. So that was great. That I would like to relive, because that was for me. But as of recent, we're kind of stuck. So going back to January, we're kind of hitting just barely positive, but we've been chopping all around this year. But it kind of gives you a good idea, like, hey, this is what the current equity curve is looking like. Let's say if you like looking at stocks, you like buying the dip, you could look at the equity curve and you can say, hey, the system is going back to June levels, or it's going all the way back to March levels. Maybe this is something that I want to participate in if I'm not following the system religiously. On a more mathematical scale, instead of like a equity curve visual, I actually use the equity curve to show the current total of my account. So I keep that on the side. Saving the best for last is the yearly drawdown table. Set to normal. Small is preferred on the phone. There's 2 different options. You have all-time drawdown, which is from the highest point recording that year to the lowest point. So if you use all-time, that's going to capture your full volatility throughout the year. So I don't personally do it, but if I look at my account and I'm up 15% in the year, and then I suddenly go down to negative 3% year to date, I don't look at it and be like, oh man, I'm down 18% this year. I usually just use the year to date drawdown, so I kind of get a good idea of like what's my actual pain score? What am I looking at here? And this records all the way back to 2009, 2010. But you can see that like in 2012, You were negative 11.7%. That was your year-to-date drawdown. You had no drawdown some year because in the beginning of the year it just lifts off and you never see negative balances for that year. Back in 2025, we were negative 21.2. I do want to mention that the numbers do change depending on which time frame you're using. So like I have premium, for some reason it's slightly different on the 8-hour, but on the daily it shifts to 29.9 back in 2025, and you get an average return rate over here on the right side of 58.7. I think that's a relatively good ratio using the system. Sorry, let me just pull up, just have something there for you. I'm a beginner, don't grill me. So now that you have all the information of every single year, all the drawdowns, how it's currently performing this year and how it performed in the past, you can make an educated guess or a decision on how to proceed, whether this is something for you or it's not. Now I have alarms set at 3:55 every single day, just so I can look at the percentage and I know how much I'm going to have a total holding of my account, which is going to have previous shares and it's going to have current shares. So you can say, hey, I'm going to be increasing or I'm going to just be holding the same thing over again today. I don't have to do my job today if you're holding. But that's pretty much the gist of it. You're waiting till the end of the day to trigger your trades. Going back onto the 8-hour for me. One last thing that I want to cover so I can wrap this up under 20 minutes for you is the capital usage multiplier. No, second thing. There is going to be two ways that you can increase your volatility, which I don't recommend, and decreasing volatility, which I always can recommend. So let's say 25.2%. Let's say you're my dad, and my dad is watching my video right now. He's learning about the system and what my business is. And let's say 25% drawdown is just way too much for him. He loves Dow Jones. He loves the stuff that is going to make little consistent gains over time and is not going to completely beat him up. So let's say $1 million account, we can do 0.7. Whenever you're going below 1, you always have to use a 0. to that. So now we're only allocating 70% to the portfolio, and the percentages are going to automatically adjust to that, so you don't have to. You don't have to go at the end of the day and just do the math and say, oh, I need to have, I need to do a 70% of my total balance, and then I got to see how much I can buy of shares. It's going to automatically do that for you as long as you set it up. But you can see how it adjusts the numbers, where now in 2025, you're down negative 14.9%. 2022, negative 14.6%. 2018, negative 16.7%. Now you have a very reasonable drawdown and a very reasonable max drawdown. And then you can go over here, you're still nailing nearly 38.8% per year. So if your goal is like, I only need 30%, you can kind of adjust your multiplier and you can deleverage and still make the returns that you want through a yearly basis, as long as that year cooperates, right? That's the gist of it. You can pretty much do 0.8. You can do just small incremental changes, even like 0.9 here, if you just want to stray away from the larger drawdown, which 0.9 is not going to make that much of a difference. But if you just wanted to stray away from like the 30%, like that closer amount, you can do so. You can just kind of have a 10% capital hold or a cash hold on your account. So that's a really nice feature that you can have for your portfolio. So you're not fully leveraged all the time, especially like if we're hitting these averages here, and let's say it's like July, and you're already up 50% for the year, it's probably not a bad idea to use the capital multiplier. Knock yourself down by 30%. Take the cash, have it sit on the side doing nothing, so when a rainy day occurs, you can pop that 30% back in when, let's say, early into the next year, if things kind of, hit the fan, you have the cash, you have the allocation that you can go into and prop yourself back up again into a better position than what SDS is in. Now, one way to increase volatility is my little friend called Soxel. It's no secret now in 2026 that NASDAQ, majority of its holdings is starting to go into semiconductors. The one thing I really don't like about Soxel, guys, is this negative 48.7%. I don't like that. That's year to date. Can you take 50% of your money and just throw it into the trash can and have to crawl your way back out for the end of the year? Like, how are you going to mentally take that in? I mean, in 2025, it did 64.6%. That's great. But you were probably shitting your pants in the early of the year, going all the way back to 2025. I mean, when we saw this stock go from $28 all the way down to like $7. But the way that I would increase volatility, and this is in my opinion, not financial advice, I have to say that, is when you're in TQQQ and you're hitting above your average drawdown, which is negative 10% or more for that year. And you go over here to Soxel and you're like, yeah, it's down 30% for the year. If I hop into this, I'm probably going to take a beating short term, which could be like a 20% beating, by the way. It's a way when you're stuck at 100% on TQQQ, you're deep in drawdown for the year, you already don't feel that good. But your average return on Soxel is 93.4%. It's still up. If with this dip, it's still up 80.6%. And even into the prior year, like, you mean to tell me that I was down 48% and it was up 64% towards the end of the year? So if we're in TQQQ and we're down 21%, so that means we're going up 80% of our cash towards the end of the year versus where TQQQ only recovered about 70%. So you can kind of like get that edge going for you with Soxel. So there's a little bit more volatility there, but by all means, like, if you're playing this and it's in profit, I mean, you got to use a capital multiplier on this stock. I mean, you're cutting down, I would say, like 0.6. Really reduce that risk down, and it's still like 31%, and its average is 45.9. I don't see the advantage of playing Soxel unless it's really deep red and your system on TQQQ is already down. Can you use this on other stocks? Yes and no. Mainly what I want to look for, let's say we want to go to Microsoft, right? Sorry if you heard that. This is going to be just the last thing, because we're 24 minutes in. The main thing for me, if we're playing an individual stock, I want to see consistency year over year, and the returns has to make sense relatively to the max drawdown. I don't really care about the average drawdown that much. I mean, that sure does play into effect, but I want worst case scenario. I'm going to be down, 20% on this, and the average is 12.9%. So for someone like me, if I want to invest in something I like this, I definitely want it to be in negative drawdown like it currently is. Like Microsoft is, no, not financial advice, but it is a good pick. You know, you're at a good level here, and it is in drawdown. So your average 12.9%, you're going to get what 25% out of this play if it has a positive year towards the end of the year. Maybe next year you can get that. So that's the way I would use it. If you go into something like, I'm not going to throw any shade here, but like something like SoFi, which I know is an underperformer, I think it is. Yeah, like something like SoFi. You have a negative 50.3% and your average is 1.5%. Like there's some certain situations that you're going to get into when you're looking at stocks and you'll be like, okay, this doesn't have the history to justify the means to trade. And you go back to the basics. So for me, I'm always using TQQQ for this. That is pretty much it. I kind of covered a lot more than what I really wanted to. I'm rambling a bit, but I hope that kind of clarifies the system a little bit and answers a lot of questions. I mean, if somebody, when I'm talking to you about the system, and I'm showing my friends, I really would like you to rely on this video and kind of go through the settings and set it up for yourself and to make your decision. This trading system is very passive, but it's also an investment mindset. You got to know that some years in the beginning, it's just not going to work out for you. Maybe towards the end of the year, you're going to get punched in the face like 2018. You were up 20%, 30% in 2018, and then you're down negative 10%. Like shit in this business just happens. And for me personally, because I created this system, I know what's in it, and I've honed it myself. This is something that I'm going to look 5 years down the road, and I'm like, hey, if I get 150% year out of these 5 years, or 250% years out of these 5 years, I beat the average return for Nasdaq and pretty much all the hedge funds. So that's my mentality of the system. I really hope that this tutorial helps out, and you guys have a wonderful day. I will provide more content in the future, especially how to test different strategies using AI, using Chat GPT, submitting information over there and having everything submitted. So maybe potentially one day that you can create a system like this yourself, because really all it is a bunch of strategies bundled together. Allocations are based on risks and returns, and then I have a couple behavioral things that I thought that was pretty special to add in there, because during the development of over the year of creating this, I saw some things I didn't like. I was like, hey, maybe we can change this around. Maybe we can be a little bit more aggressive with the trend system. Maybe we can be a little bit more capital preservation on deep drawdowns. But I'll talk to you guys later. Thank you for watching this video. If you made it all the way to the end, you guys have a wonderful day. I'll see you later.